For Morningstar, I'm Jeremy Glazer. Inflation data this week confirmed that Social Security beneficiaries are going to get a very small increase this year. We're with Bob Johnson, our Director of Economic Analysis, to look at that inflation data and what it could mean. Bob, thanks for joining me.
Great to be here today.
Let's start by looking at that headline inflation number. Any signs of acceleration here?
You know, the headline number overall hasn't gotten much worse in recent months. We've kind of been at that 1 to 1.1% over the last several months on that headline inflation number. But, you know, looking back, it kind of creeps up on you. But a year ago at this time, the number was more like 0.1%. So we really have moved up quite a bit even on that headline number. But the 1.1 seems kind of tame. Now, you look at the core number, and that number is, again, higher, about 2.2%. And again, if we look back a year, it was more like 1.8%. So it's moved up, but maybe not quite as dramatically. But it is 2.2%. And as the effects of energy kind of burn off, as we kind of stabilize, not even increase, but stabilize energy prices, it's highly likely it will move to that core number of about 2.2% inflation.
So now this report is used to calculate what Social Security is going to look like next year. It's going to be a pretty small increase.
It absolutely is. And remember, this time around, they're going back to 2014 data to compute the number because we didn't have a Social Security adjustment at all last year. Recall there was no hike in the Social Security payments at all in 2016. Now, as we look to 2017, the number will go up a whopping 0.3%, hardly any better.
And you said that's around $5 for the average Social Security.
Right. The average check's about $1,300, and that 0.3% gets you about there. So certainly not good news, especially considering Medicare premiums for some will go up. Not all, but for some. And in addition, for everybody, the deductibles will go up more than the amount of your increase in Social Security. So certainly not a good situation.
And for those that are currently working, the wage base is going to increase quite a bit more.
Yes, there's some very tricky things there, but usually the wage base determines how you set your rate and how much what your limit is on what's withheld. And it was about 118,000, and that's going to move up to 127,000 because we're going to have a catch-up year because you're not allowed to adjust that base in years when there's no regular Social Security increase. So we're going to get a double whammy of 2 years of increases, and wage increases have done better than inflation, and so therefore this index is going up quite a bit. So people in the higher income brackets are going to face a pretty nasty tax increase from this higher wage base next year.
So if you have higher taxes on some workers and then a lot of retirees maybe not seeing a big change to their income, does that make you a little bit nervous about consumer spending? There's just less money out there to spend. You
know, I absolutely do. It's a big deal, and I think it's partly restrained some of the numbers this year. Next year it's going to be even worse with the wage base issue. But it's a very small increase that's out there, and you know, that's about 1 in 5, 1 in 6 people in the U.S. economy get some type of benefit currently that's tied to that number, and so they're not getting a rate increase. And as we just talked about, inflation is accelerating, but this is kind of a look-back number, so the chances are they're going to pay prices that are about 2% higher next year, and they're not going to get any increase in their base. So. That's really a nasty combination for a decent part of the economy. So clearly that's one of the reasons that we've been more pessimistic lately. We usually are relatively optimistic on the economy, but we've got some pretty grave concerns right now.
Let's look at the impact on the Fed then. If you do see inflation coming up and you see growth being very slow, are we back in stagflation, if I can dust that one off?
Yes, I kind of think that's where we're at. I think we're going to be looking at over 2% inflation and very limited GDP growth, kind of in the 1.5% to 2% range. So we're clearly in a situation where we're facing slower growth. But on the other hand, because of demographics and just the way things flow through and energy not falling as much as it was, we're going to be in a situation where inflation is moving up at the same time that growth rates are kind of moving down, the very definition of stagflation. And it puts the Fed in a terrible bind in what to do and why everybody's having such a hard time figuring out what they will do, because you've got this clearly brewing inflation issue out there. And at the same time, you've got this issue where I think it's going to be very clear to people over the next 2 or 3 months. We've had a pretty dramatic slowing in the U.S. economy.
So a December rate hike still a possibility? How do you think they'll handle it?
It's still a very real possibility, and it depends on how bad the economic data gets between here and there. If it kind of some of the smaller things that we're seeing don't brew to the surface by December, then they'll look at the inflation data and say, you know what, we should probably do something. But if we have a couple bad employment reports, if we see a really poor GDP report for the third quarter, those are all things that would make them hold back. Personally, I think they should have moved earlier while the economy was a little bit stronger, and that would have actually reassured people in a way that they had enough confidence in the economy to raise rates. Now, I think it's kind of too late. I think that if they raised rates now, it would sink the economy. So my advice to them has probably changed over the last 6 to 9 months.
And we did see some poor reports this week, particularly in housing.
Yeah, I was not at all pleased with the housing report. And again, a lot of people are making it out as a pretty dramatic number. They're looking at the number month to month and saying, oh, we're down 10% month to month. Well, the month to month numbers are always volatile, and we've got those tough seasonal factors. And starts were running way ahead of permits for a while. So the starts data looked really quite poor, and that's also true year over year. But, if you look at it on a more rational basis and look at kind of a rolling 12-month basis, we're still growing 8-9% year over year in the single-family market, which is the key market. But again, that's not the 12% that it was, say, 6 months ago. So we've kind of slowed there, and that's not good news because we've got a lot of visible problems in the economy, and we'd hoped for housing to kind of bail us out, if you will. And certainly the permits data this week did not do that.
Well, Bob, as always, I appreciate your analysis.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.